Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Chicago wheat, Chicago corn, and Kansas City wheat. Chicago wheat. The main activity here since December last year is twofold. Before looking at those, there is a pattern in operation that I've highlighted since last summer, and one that still needs highlighting. You see, some while ago I had pointed out the cat's ears pattern over June and July 2023. In essence, this is a double top formed in an overall downward moving market. Potential below for such a cat's ears pattern is target X2 in the 502 zone. For a while during autumn it looked like we would never get there, but since late November and especially December last year, the market gradually started to approach this potential pattern target. In March this year, we had the closest so far approach towards target X2 down to the 38.2% absolute Fibonacci line at 521. And this is where the idea might have come out unstuck, as this 38.2% absolute Fibonacci line saw a rejection in March, a climb up and away. Now, prices have pushed up over the bright red highlighted March 2022 to date downtrend, currently at 525, and most recently over the bright green highlighted upper time, currently at 564 of the broken and may be repaired late December 2023 to late January 2024 bearish shift pitchfork, and for a while over the short medium moving average, currently at 573, which had reinforced the upper time since February. However, the market has not really lost contact with the upper time, traveling along the top of the time for the last week and a bit. So I'm minded to still keep the idea of a move to target X2 at 502 still alive for now. I'll also for the moment still keep the bright red downtrend also on my daily chart, for the same simple reason that the bright green pitchfork is on there. They have in the past, especially the downtrend, been excellent at showing the recent bearish angle of attack. So what can we say about this very recent rise? Well, it is from a potential V bottom, but it has, as I said last week, some significant resistance overhead from the flatlining medium moving average, currently at 592. That is currently at the March low of 592 as well. However, better resistance is further up at the combination of the July 2021 high at 609 and the declining long moving average, currently 610. Between these two areas, we saw considerable congestion between September and November last year, and again in mid-January to mid-February this year. So it is not as deserted as it may first appear. Chicago corn. The medium moving average, currently at 458, highlighted in mauve on my daily chart, had been an effective cap on this market throughout 2023, most recently in October, November, and then December 2023. When it was penetrated in December of last year, it still held down the market, and it has for the last 4 weeks also acted once again as a cap on the rises. Additional to the declining medium moving average and further up, we have the same old congestion band overhead between 490 to 498, including the 2021 low at 498. We also had the short medium moving average for a while, currently at 441, highlighted in green on my daily chart as a resistance, especially when it was entangled with the medium moving average late last year and then later enmeshed with the now broken dark blue highlighted February 2023 to date downtrend, currently at 432. The short medium moving average, well, I'll return to these two shortly, going back a bit to mid-February, and prices had punched down back then, reaching the primary target at 424. for the July 2023 to January 2024 descending triangle highlighted in bright red on my daily chart. In the process, the market also punched down through the important 50% absolute Fibonacci line at 425. However, this piercing move lower was too much for the market to swallow in one go, even though it also breached, though it did not break, the next support below, which is the December 2020 low at 414. It's from there that we saw a strong recovery, creating a nascent bull channel from late February to late March, which 2 weeks ago the market broke on the downside and found a combination of support to seemingly base itself on at the November 2020 high at 439, plus the green highlighted short medium moving average and the top of the broken dark blue downtrend. I told you they would feature again. So 4 weeks ago I spoke on this rise and I said at the time, and I quote, "So it is significant attempt higher. As to whether it will succeed, well, that is a close run thing at the moment. But I would observe that we have not accumulated that much ammunition below, so it will be interesting to watch." Now, I'm still, end of quote. Now, I'm still minded to think that despite the attempted V bottom in late February and a subsequent failed small bull channel, it still looks like the ammunition below is not enough, not yet at least, though we have tended to see a more sideways move over the last 2 weeks. That reinvigorated the move lower, and I'm wondering if there's actually a handle on the side on a diving board platform, but we'll see about that later. All I can really add to this is that the weekly key reversal up we saw 2 weeks ago does not look like it has a follow through higher. And I repeat the same sentence I gave last week, and I quote, "Just be mindful of target X1 below at 374. This is the secondary and much harder to reach target for the descending triangle." End of quote. Kansas City wheat. A lot less going on here today than it was 3 weeks ago. However, despite a relatively narrow range, there's still a lot to see here within a fairly narrow piece of action. Not in market price movement, but in a narrow piece of market angle of attack action. To explain once more, 21 weeks ago, I highlighted a feature I saw whilst I was looking at the action since August 2023. It was a descending expanding wedge pattern, currently 554 to down off the bottom of my daily chart, and it's highlighted in dark blue on my daily chart. This is not the best example of such a pattern, but as I said 19 weeks ago, and I quote, "It does hold merit, and I would look to this pattern for some immediate idea of the move downwards." End of quote. Well, it did until recently show the way lower, but it wasn't an easy decline, having been pierced on a number of occasions, and now seeing the market running along the top of the upper trend line and possibly preparing to pull away during its lifetime. Pulling away. Now, during its lifetime, I've also seen the development of 2 new patterns, one of which involves the descending expanding wedge pattern itself. So back in early December last year, we had an attempted move higher, but it ran into the combination of the upper trend line of the descending wedge pattern and the green highlighted declining short medium moving average, currently at 585. Indeed, for a while, this pair of dynamic resistances held prices down. However, at the start of 24, they had started to separate, and in late January this year, we saw the market head lower. Initially, I thought it might be a descending scallop pattern, but the market was and is too stretched out to be a descending scallop pattern. And so instead we still have I suppose, a descending triangle idea from late November 2023 to mid-January 2024, which is highlighted in purple on my daily chart, with the trend lines for both crossing over early 2 weeks ago. Now, 9 weeks ago, we had an attempted breakout below this descending triangle, but prices hesitated and have continued to hesitate, such that what I initially thought we might be a triple or a quad bottom is now a quintuple bottom and looking more like a rectangle pattern in shape. Now, I'm still not sold on this idea, but I can see it happening, of a rectangle shape that is. Now, also now note the descending medium moving average, currently at 606, now entering the frame from above, which I have highlighted in mauve. This has run in parallel and just above the dark blue upper trend line of the descending wedge pattern since it started in August last year, and also more recently with the upper trend line of the purple purple upper trend line of the descending triangle. I wouldn't say it was acting or influencing as a resistance, not yet at least, but it has managed to perhaps have a corralling effect of some form. So for the moment, I can still lay out, as I did last week, some ideas below. For a break lower from the descending triangle, thus a primary target X would be in the 539 zone, with a secondary, harder to reach target X1 down in the 487 zone. I don't like what the continuing sideways movement may have as an effect on the break below the descending triangle, but I will keep those targets below for the pattern for now. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpick and ADM Investor Service International Limited. And here comes the final important bit.